Advanced Financial Modeling, Topic 9, Forecasting Financial Statements, Free Cash Flows, and Stock Valuation. Learning Objective number 4. We're going to understand and forecast free cash flows. So let's talk about the concept of free cash flows. You can think about the ultimate goal of a company is to generate cash for its owners. However, specifying what cash measure you're going to use isn't a trivial matter. So what we're going to use is a concept called free cash flows, or a measure. It's a measure of the ability for a firm to generate cash, free cash flow. Free cash flow, let's just decide what it's not first. Free cash flow is not the same as the change in cash in the balance sheet. For example, you could increase balance sheet cash flows by simply borrowing money. So that would show up as generating cash, but that wouldn't be a good way of evaluating a business, the ability just to borrow money. Also, free cash flow is not the same as profit, accounting profit, because profit doesn't include some non-cash revenues and non-cash expenses like receivables and payables. Or does include those items which generate cash or use cash but are not in the revenue number or cost number. Also, the profit does not include new investments in working capital. So if you had to spend a lot of money on an inventory, that's not going to show up in profit, even though it's a use of cash. And lastly, CapEx is not going to show up in accounting profit immediately when you actually spend the money. It's going to show up later as you depreciate the items. So for those reasons, cash flows, especially free cash flows, and profits are not the same thing. So we're going to use the term free cash flows for making adjustments for those things I just mentioned, the differences between profit and cash flow. All right. Unfortunately, there are two free cash flow measures we're going to have to use. I'm going to call one unlevered free cash flows, or free cash flows to the firm. We'll call it FCFF. And then I'm going to use one called levered free cash flows to equity, or FCFE. So FCFF, unlevered free cash flows, or FCFE, levered free cash flows, or free cash flows to equity. So let's talk more about this concept of free cash flows. The one I mentioned first, that free cash flows to the firm, or unlevered free cash flows, are cash flows generated by an unlevered company. What does unlevered mean? Well, how much cash they would generate if they had zero debt. All right, so we're going to just pretend a company, even if a company does have debt, we're going to pretend they have no debt and see how much cash they would generate, basically allowing you to ignore borrowing of money, interest payments, and so on. So what does FCFF allow you to do? Well, it allows you as an investor to evaluate a business's ability to generate cash from its operations, meaning excluding debt service, interest payments, or dividend payments, but including investments in working capital like receivables and payables, and capital expenditure needs like buying fixed assets or property, plant, and equipment. The equation I most often use for calculating FCFF is I'll start with EBIT. I'll take out taxes. Remember, EBIT is going to be your revenue minus COGS minus SG&A. So I'll start with that EBIT. I'll take out taxes by multiplying times 1 minus the tax rate. Sometimes we'll call that the after-tax EBIT. And then, I should put in EBIT, we're also going to subtract out depreciation. So it's important that I did that. So EBIT is revenue minus COGS minus SG&A minus depreciation. We'll take that after tax. Then what we're going to do is add back depreciation, because depreciation is a non-cash expense. We're then going to subtract any expenditures in the current period on capital expenditures. In other words, it's purchasing of things like vehicles and equipment and buildings. And then we're also going to subtract changes in net working capital. So net working capital we're going to define as basically current assets minus current liabilities. But I'm going to say more, it's operational or operating current assets minus operating current liabilities. So let's talk more about this concept of net working capital. So it's generally going to include most short-term assets and most short-term assets and liabilities. However, what it's going to exclude, sometimes it's going to exclude cash, sometimes it's going to include it. And the answer is whether you include it or exclude it is if cash is needed to run the business, include it. treat it just like inventory. If cash is not needed to run the business, the cash is just being held for other reasons, say as an investment, then you'd ignore the cash. And you also then want to subtract off accounts payables. So mostly it's accounts receivables plus inventory minus accounts payable, and sometimes add cash to get all these from your balance sheet. Okay, net working capital always excludes interest-bearing loans or debt, any kind of interest-bearing liabilities. So debt and bank loans are excluded from net working capital. And as I mentioned, cash is excluded as cash is not required for operations. So again, just think of it as if a business just needs a certain amount of cash on hand, either in a cash register or just in an account to handle net reimbursements, expenses roll in. That's an operational cash. You need that just like inventory. But if that's not it, and most modern corporations don't really hold a lot of cash for that reason, you can exclude it. So let's talk about why do firms hold so much cash if modern firms really don't need cash, especially with credit card payments and wiring funds. You don't really need a lot of cash. So why do corporations hold cash? Here's a fun fact from a few years ago. At this point in time, Apple had about $157 billion of cash, Microsoft $82 billion of cash, GE $62 billion of cash. So why does Apple need so much cash? By the way, that amount of cash that Apple had that year, it's about the amount that the country of Mexico had in foreign currency reserves. So that's a lot of money. So why would someone or a company hold so much cash? The first answer could be that they just needed to run the business. It's transactional cash balances. They need cash to put in the cash registers. They need cash in accounts. So if they have to write a check, there's money available. So when we talk about whether or not cash is included in net working capital, if it's for this reason, we call it operational cash, and it is included in net working capital. But these other reasons I'm going to list, you would exclude it. In most modern corporations, you can most likely exclude cash from net working capital. So why else do you hold cash? Well, sometimes when an organization or a business borrows money, the bank requires them to deposit a certain amount of that money as a cash balance. That's called a compensating balance. Another reason is sometimes companies just hold cash as kind of a rainy day fund. In case things go wrong, I want to have some cash on hand. Or they're holding it because maybe in the future I want to purchase a competitor. So I'm just holding on to cash for future purchase or in case things turn bad. So we call those precautionary balances. And sometimes people talk about repatriation tax avoidance. So sometimes if an organization generates, say a U.S. company generates cash from its European subsidiary, it's often taxed when that cash is brought back to the States. But if they don't bring the money back to the States, it doesn't get taxed and it continues to generate some interest income. And also maybe they can use the cash for when they expand foreign operations. So a lot of companies are trying to avoid taxes. So they'll hold cash in offshore accounts. And so for that reason, it will be held. All right, so these are all reasons why firms could hold cash. Modern corporations, probably the least likely is they're holding it to run their business because of all the digital payments. And I'm guessing Apple doesn't need $157 billion in its cash registers. All right, so when we talk about whether net working capital includes cash, well, if the business needs cash for operations, this reason, include it. In general, I'm going to exclude it because I would think most modern corporations don't need that much cash. All right, so let's talk about the calculation of FCFF again. Free cash flows to the firm. FCFF, you can take your EBIT. Again, that's revenue minus COGS minus SG&A minus depreciation times 1 minus the tax rate. That would basically be net income if they had no debt or interest. So you can think of that as unlevered net income. However, you're going to add back depreciation because depreciation is an EBIT. You need that to calculate tax, but it wasn't a real cash expense. It was a fake cash expense. Well, it's an IRS recognized cash expense, but it's not actual come out of your pocket. So I'm going to add back the depreciation. I only included it over here to calculate taxes. And then I'm going to subtract CapEx because those are investments that cost me cash. I'm buying delivery vans, I'm buying new computers, I'm buying new machinery, I'm buying new robotics. Those things get capitalized over time, maybe 5, 10, or 30 years, but I want to actually show when the business spent the money. And then I'm going to subtract changes in net working capital. So again, net working capital, that's going to be accounts receivable plus inventory minus accounts payable, and sometimes cash, but usually not. So why am I subtracting changes in net working capital? Well, if some of the sales included in revenue, included in EBIT, were generated, but the bill hasn't been paid, they're sitting in accounts receivable, that means some of the revenue is not actually generating cash yet. So I'm going to subtract that. However, some of the accounts payable that are in, say, COGS or SG&A, maybe you haven't paid that bill yet. So it's included in EBIT, but actually it hasn't cost you cash yet, so I'm going to exclude that. And then inventory. Inventory is not included in EBIT. It's included in COGS as you sell the good. It's cost of goods sold. But until you sell the good, it's sitting in inventory. That's costing you cash. And a lot of organizations have to generate lots of inventory to put on the shelves or put in warehouses to ship in a timely manner. That costs the business money, lots of money for organizations. So we want to make sure we subtract an increase in inventory. So that's why we're subtracting changes in net working capital. All right. When we talk about levered free cash flows or free cash flows to equity, we then allow, it's basically the same thing as FCFF, but we're also including debt and interest payments. So instead of starting with EBIT, you're starting with net income. What's the difference between EBIT and net? Well, I should say EBIT after tax. We now start with net income. Why? I'm allowing it to subtract interest payments. I'm going to do the same adjustments for adding depreciation, subtract CapEx, subtract changes in net working capital, but I'm also taking care of the actual debt issuance. If I issue more debt, that generates cash. If I pay down my debt, that uses cash. All right, so there's our two measures, unlevered FCFFs and levered FCFEs. So let's do a little exercise. Let's go ahead and calculate FCFF and FCFE for this firm. We're going to jump to Excel. And what you see is 2019 balance sheet income statement, 2018 balance sheet income statement, and we're going to calculate FCFF and FCFE for 2019. We'll start with EBIT. You can actually see here, I've already calculated for you net income. So net income in 2018 is sales minus COGS minus depreciation minus interest times 1 minus the tax rate. And the same here. So that was our net income. This company is generating $296 in net income in 2019. But did it generate cash? Well, let's take a look. Here's its balance sheet too. All right, so let's take a look here. Well, it looks like there's a number missing. Let's fill that in. Accumulated depreciation. Well, this company in 2018 had accumulated depreciation of 200. And then, so what would be the accumulated depreciation to calculate net fixed assets in 2019? Well, it had 200 the prior year, and then I'm going to add to that depreciation in the current year. So if it had accumulated depreciation of 200 and it depreciated another 125, that's going to be 325. So that just gives you an idea how to calculate fixed assets at cost, accumulated depreciation, net fixed assets. This is the row it actually adds into the balance sheet. All right, back up here. Let's go ahead and do EBIT. EBIT is going to be my sales minus my COGS minus my depreciation. I'm sorry, SG&A minus depreciation. Then I'm going to subtract out the tax. I'm going to do this, I could have done this in one step, where I can just jump here and take 400 times 1 minus the tax rate, but I'll do it here in two steps. So I could have done it this way, just jump right to this row and say EBIT times 1 minus the tax rate. But I'll do it the old-fashioned way, minus EBIT times tax rate. And then I'll add that taxes and that EBIT, and I get to 300. So far so good. Now, CapEx. Well, from the balance sheet, you can see that their fixed assets at cost went from $750 to $950. So it looks like they bought an extra $200 of fixed assets in 2019. I'm going to subtract that $200, that increase in fixed assets at cost. I'm going to add back the depreciation in the income statement. Because remember, depreciation is an EBIT, but I just need it to calculate taxes because the IRS recognizes it as an expense, but it's not a real cash expense, right? The idea is depreciation comes from past CapEx. Here's another reason why we want to also subtract CapEx and add depreciation. If I didn't add depreciation back, I'd be, in some sense, double counting, because the depreciation and CapEx, they're the same concept. If I pay for an item $200, it's going to show up in future depreciations. So I need to make sure that I subtract CapEx, add back depreciation, so I'm not double counting CapEx. And then minus changes in net working capital. You can see I have a calculation here. 2018 net working capital is, in this case, this is including cash. So this is the net working capital including cash, and that's cash plus receivables plus inventory minus payables, but it doesn't include debt. And then I do the same calculation in 2019. So the change is the net working capital, including cash, increased by 53. If I do non-cash net working capital, I just exclude the cash line item, and it's 28. So let's just say we're going to assume in this example that cash increase was needed, or all that cash is needed to run the business. So I'll subtract this number. If I told you that cash is not needed for operations, you would subtract that number. But I'm going to go back. All right, now I can just add those together, equals sum from EBIT after tax. And it looks like this business generated 172 in cash, which is considerably different than profits. Profits are not cash. Why does this company have 296 in profits and 172 in cash? Well, you can see, one, we're excluding interest expense, so that would actually make the number higher. But the main reason is it's spending money in CapEx. So if this business is needing to buy more and more CapEx and more, say, inventory that's in receivables, it's hurting its ability to generate cash. So it's a less attractive business than we initially thought if we're just looking at profits. And then we have a calculation for FCFE here. Notice for FCFE, I start with net income. I do the same three adjustments as above, subtract CapEx, add depreciation, subtract changes in net working capital. But this company, if you look at the balance sheet, you can see their debt went from 100 to 150 in 2019. That's an increase in 50 by 50, so I'm going to add debt issuance. If I paid down debt, I would subtract it. So this company is generating 218 in FCFE. Although I'd be nervous to think about this, being a healthier business because I'm looking at FCFE, because part of that cash is just issuing more debt, right? If I take that debt out, it's not doing as well as you thought. Okay, so that is FCFF and FCFE. We'll do one more exercise, just a different way of calculating to show you the various ways we do FCFF and FCFE. We'll just do FCFF in this example. So in this one, I have some assumptions here. That in this year, they had revenue of 500, that's last year. Revenue growth of 20%, COGS and SG&A as a percentage of sales is 40%. That means whatever sales forecast is, 40% of that is going to be SG&A and COGS. Depreciation, we'll just do a percentage of sales is 10%. Tax rate, 25%. Net working capital, percent of sales. That's another way of thinking about it. This company needs to have net working capital, operational net working capital equal to 15% of sales. CapEx is a percentage of sales, so everything's being done here as a percentage of sales. And what you see is we have to forecast year one. So you can think of year zero as today or just completed. Year one is 1 year from now. So what is my revenue 1 year from now? Well, if last year's revenue was 500, I'll multiply times 1 plus the growth rate. COGS is going to be 40% of sales. It's a good place to mention this. I haven't mentioned it before. Sometimes I show, expenses like COGS and SG&A as a negative number. And usually when I do that, I'll put negative here just to show it. But I decided here not to do it. And you have to kind of get used to it. You can flip a coin when you look at income statements or company financial reports, whether they show expenses as negative or positive. You just need to know the answer when you do subtotals. So I'm going to not show it as a negative here. All right, so we got depreciation is equal to, looks like 10% of sales. Always use the current level of sales. Now I got EBIT, revenue, minus COGS, SG&A, depreciation. Taxes are going to be 300 times the tax rate. Again, I'm not doing interest because I'm doing FCFF, the unlevered free cash flows. So I now have EBIT after tax of 225. I'm going to add back depreciation. I'm going to subtract CapEx. Notice CapEx, it says minus CapEx, so I will put a negative sign in front of that. CapEx is a percentage of sales. Say on average, this company spends 20% of new sales in CapEx. And minus the change in net working capital. Here I have the calculation that if you assume that they spend 15% of sales in net working capital, receivables minus payables plus inventory, and the new year sales are 600 times 15%. The increase in net working capital was 15. I want to subtract the change. Common mistake is to always add that. It's always minus the change. Now I can just sum up EBIT after tax down to changes in net working capital. And this company is generating $150 in FCFF. And you can see that's considerably lower than the EBIT after tax because there looks like they're spending a lot of money on CapEx. One thing I'll often look at, and this kind of, I'll do it for when I evaluate companies to think as an investment. This company is generating, or it's spending 120 in CapEx in this year, and its depreciation was 60. So one way of thinking about that is it's spending more than it's depreciating. If you think of depreciation as kind of the wearing out of assets, if the company's in steady state, you would think CapEx equals depreciation. As a computer or a delivery van wears out, you buy a new one. So you'd see these numbers often are the same value, just positive and negative. The fact that CapEx is bigger than depreciation tells me they're actually buying more computers, not just replacing, buying more delivery vans, not just replacing. So in that case, this is probably indicative of a company that's growing, and they are growing. What I'd be nervous is if CapEx was smaller than depreciation and we're forecasting growth. Well, where's that growth coming from? Where are we getting the additional production facilities? Where are we getting more delivery vans? Where are we getting more computers and robotics? All right, and the last thing I want to do is I want to show you how to do a data table. So what we'll do is we'll look at FCFFs and see what different levels of revenue growth and CapEx percent would do to my free cash flows. So again, let's go back here. To do a data table, all you need is one row of values for one parameter, revenue growth here, and one column of parameters or inputs for CapEx percent. And then I'll have a link here to the original function or formula that calculates FCFF. And then I'm going to select this whole area and hit Data, What If, Data Table. And it says, what's the row input cell? Now the rows are revenue growth numbers. So let's go back to the original revenue growth number of 20%. And the column is CapEx as a percent. That's 20%. And just hit OK. Now, what do you have here? Well, my basic assumptions were that CapEx is 20% and revenue growth is 20%. And when I did that, I got $150 FCFF. But what this allows me to do is this created a 5x4 matrix, 20 possible FCFFs. What if revenue growth was only 5%, but I'm still investing 140 in CapEx? So it gives me different values, different scenarios for that. All right, so that's how you do a data table. All right, last slide for this section. Free cash flow uses. What do we do with all these free cash flows? Well, it's used to evaluate a business's ability to generate cash for its capital providers. And when we talk about that, we talk about FCFF, because FCFF tells me how much money a business is generating before interest and debt payments and dividend payments. So it's really how much money is available to pay the debt holders and the owners. Sometimes FCFF is used to evaluate a business's ability to generate cash just for its owners. In that case, it's FCFE, because I've already subtracted, say, interest payments and repayment of debt. However, I'm going to posit to you that FCFF is a better measure of the overall effectiveness of a business to generate cash from its operations. So that is going to be my number one measure for the health of a business, FCFF. Remember, FCFE can be inflated by just issuing more debt. Now, the only thing I'll caveat to that is a lot of high growth companies, their FCFFs look bad because they're spending a lot of money in CapEx, which will then allow the company to maybe grow in the future. So that's the caveat. Some companies that have terrible FCFFs, because they're building for the future with lots of CapEx, look bad on that measure. But if I'm looking at a mature firm, FCFF is the number one measure. And also FCFFs, those unlevered free cash flows, are most often used to value common stock, which seems surprising. You would think common stock, FCFE, why wouldn't you use that? But we'll talk about that in the next section.